Last audit and assurance, we were covering audit planning and audit risk areas. Till now, we have covered three good questions on audit risk: Papaya, Global, and Parker. So let's move towards one more question called Bill. Bill is part A of the question. And if we see requirements are in between the question, so let's start reading the question and move towards requirement. So you are a senior audit manager in Saki and Company, a firm of chartered certified accountants. This morning you have been reassigned to the audit of Bill Company, a long-standing audit client of your firm. As the manager previously assigned to the client has been taken ill, and Bill Company has a year ending 30th June 20X1. And the audit planning has been largely completed by the previously assigned audit manager Tara Lafitte, who had been recruited by your firm 4 months ago. So you have been reassigned to the audit. Might be you were removed before, now you have been reassigned. Why? Because the audit manager working on this client have taken ill, sick leave. And the audit manager working on this client was lacking experience just 4 months before she was appointed as audit manager. And now you have to continue the audit instead of Tara. And audit planning she has completed. But now you will be responsible for the audit. So whether you will continue with the same planning? No. You will perform planning by yourself. You will review her planning. If there is anything need to change, ultimately you need to incorporate because she was lacking experience as well. So Bill Company is a property development company specializing in regeneration and refurbishment of old industrial building. In what your client are doing, they operating in property development sector. They refurbish industrial old buildings which are sold for commercial or residential use. All property development are performed under specifically negotiated fixed price contract. Mean your client perform work on fixed price contract. The company was founded 35 years ago by two brothers Alex and Ben Bradley, who own the majority of company's share capital. Alex and Ben are nearing retirement age and are planning to sell the company within the next 2 years. They are planning to sell the company to take a good bid price. This means they need to show good results. Then they can attract high bid price for their company. And to show good results, there could be chances of manipulation. The forecast revenue for the year ending 30th June 20X1 is $10.8 million. The forecast profit before tax is $2.5 million. And the forecast statement of financial position recognized total assets of $95 million. Why? Materiality. Revenue, profit, and total asset figures are given. So you have just received the following email from the audit engagement partner. To audit manager from audit partner regarding Bill Company audit planning. Hello, thanks for taking on the role of audit manager for the forthcoming audit of Bill Company. Number one, I have just received some information on two significant issues that have arisen over the last week from Sam Compton, the company finance director. This information is provided in attachment 1. And there is attachment 1. I'm asking you to prepare briefing notes for my use, in which you explain the matters that should be considered. Does that mean explain the matter that should be considered? Accounting standards involved you need to discuss plus materiality. Relating to that issue, if there is any accounting standard involved, what accounting standard says about that situation, you need to explain, as well as you need to calculate materiality. In relation to the treatment of these two issues in the financial statement, regarding both the issues separately, and also explain risk of material misstatement relating to them. Similar way we practiced the previous three questions. We discussed the accounting standard. If there is any materiality calculation we can make, so we need to show that as well as if company is not accounting as per that criteria, what could be a chance of misstatement. But now we need to state separate matter. We need to discuss separate, and risk of material misstatement we need to discuss separate. I also want you to recommend the planned audit procedures that should be performed in order to address those risks. And regarding that matter, you need to provide some audit procedure as well. In the similar way, like in the previous question, Bluebell, we discussed the two matters. One was relating to deferred tax asset, and one was relating to share-based payment. We discussed the matter, we provided the risk of material statement, and then in part B, examiner asked to write down the procedures. So similar task we need to perform here. There are two matters. For each matter, we need to discuss the matter to be considered, mean accounting standard and materiality. We need to discuss risk of material statement, and we need to discuss audit procedures. We will put a heading issue 1. We'll discuss its matter. We'll discuss its risk of material misstatement, and we will discuss its audit procedures. And then issue 2, we'll discuss the matter. We'll discuss the risk of material misstatement, and we will discuss the audit procedures. Is that how many marks are there? 16 good marks. This means one issue we need to discuss for 8 marks. Is that 8 marks? If we explain 5 audit procedure, remaining 3 marks we can leave for matter plus risk of material misstatement. Is that? Because we need to discuss materiality as well, we need to discuss accounting standard treatment, and then we need to link with the chance of misstatement. So 4 to 5, at least a 4 procedure should be there. So moving towards attachment 1, what is requirement 2? We don't know. This is relating to attachment 2. So attachment 1, information from Sam Compton, finance director of a bill company. In the last week, 2 significant issues have arisen at bill company. The first issue concerns a major contract involving the development of an old riverside warehouse in a conference center in Bridgetown. An architect working on the development has discovered that the property will need significant additional structural improvements, the unavoidable extra cost of which is estimated to be $350,000. They are working on a contract, and now during the development stage, they realize they need to incur $350,000 extra cost. The contract was originally forecast to make a profit of $200,000. This means now they need to incur $350,000 extra cost. This means this contract will not be profitable. It is going to be $150,000 loss-making contract. And it cannot be cancelled. You have to complete. The development is currently about 1/3 complete. and will take a further 15 months to finish, including this additional construction work. The customer has been told that the completion of the contract will be delayed by around 2 months. Not only extra cost will be there, you need extra time to complete the project. And if you have signed a contract with the customer to deliver this project at a specific date, and if you are unable to deliver on specific date, there could be contractual breach penalties. Is that? If there are any penalties specified in the contract, you need to create provision for those penalties as well. However, the contract price is fixed, and so additional cost must be covered by bill company. There is a accounting standard we covered, IFRS 15. Remember, we have covered this standard in our report section. For IFRS 15, this is not revenue, this is construction contract. Revenue should be recognized as per 5-step model, but this is construction contract. In case of construction contract, we should record revenue as per percentage completion of work. Every year, how much work we are completing, we will record a percentage of that revenue as revenue in that year. And cost actual incurred in the year, we need to record in that year. And then if the contract is becoming loss making, we need to create provision for the amount of loss. Is that? In case of construction contract, out of this cost, the recoverable portion that you can recover from customer, that should be recorded as inventory. Irrecoverable portion of cost should be recorded as expense in P&L. This is something new I am adding now. So cost relating to construction contract, the recoverable portion that we can recover through revenue, that should be recorded as inventory current asset, and irrecoverable portion should be recorded as expense in P&L. As this contract is becoming loss making now, out of these 350, 200 cost company can recover with the profit. The 150 company cannot recover. This means for that 150 company need to record provision. Is that? And these 350,000 extra cost company need to incur. For these 350,000 extra cost, we need to calculate materiality as well. With what amount? Company revenue, company profitability. Compare with this, and it is material. And 150,000 loss, we need to calculate materiality with the profit as well. And that is also material. So first we will discuss about materiality. 150,000 as well as 350,000. And then we need to discuss for IFRS 15. If the contract is loss making, we need to create a provision for the amount of the loss. And the cost, the recoverable portion, that is 200, should be recorded as inventory, and the irrecoverable portion of the cost should be recorded as expense in profit and loss account. So this accounting treatment we will explain here. And then risk of material statement, if company haven't recorded provision for IAS 37, IAS 37 or IFRS 15, IFRS 15 regarding the loss making contract is also called onerous contract. If we use the word onerous contract, examiner will be even happy. This term has been used in IFRS 15, loss making contract. If the provision is not created for the onerous contract, chances that expenses, liabilities could be understated and profit overstated. Is that? And then there is information company is going to complete the project 2 months after the agreed date. And if company is going to breach any of the contract condition relating to timely delivery, so there could be further chances of penalty imposed by the customer. And if there are chances of penalty imposed by the customer due to late delivery, further provision per IAS 37 is required. Is that for penalty? And if that provision is not created, expenses, liabilities could be understated and profit overstated. Penalty due to late delivery. Can we discuss this matter and risk of material misstatement? Matter mean materiality plus accounting standard involved in its application. And risk of material misstatement, if that accounting standard is not applied, what could be the chance of misstatement? Now we need to write down the procedures. Who is saying 350,000 extra cost is required? An architecture working on that development discovered that. This means we need to inspect or review that architecture report to make sure 350,000 extra cost is required, not more than this or less than this. Because if the cost is more required, ultimately there should be more provision. If the cost is lesser than 350 required, then there should be lesser provision. So first we need to make sure 350,000 exact cost is required. So inspection of architecture report. To verify extra cost of 350,000 are required, not more or lesser than this. Is that? What else? The project was originally for 200 profit making. How we can verify this was 200 profit making? Because if it was profit making of 100 or 150, ultimately the premium amount would be different. How we can verify the project was for 200 profit making? Budget copy. Budget. So inspection of project budget copy to verify project forecasted profit was $200,000. Is that? Discuss with management. Done. So discuss with management regarding the treatment of the matter as well as accounting for it to see if reasonable. Discuss with them how you are going to account for it, how you are treating this matter, what are the chances of further penalties to see if reasonable. Mean they are adopting appropriate approaches or not. Whether there is chance of penalty for late delivery or not, how we can verify. Contract inspection of contract with the customer to identify any breach of condition due to late delivery imposed any penalty. Because if there is breach of condition imposing any penalty due to late delivery, ultimately provision is required. If there is no breach of condition, no penalty, no provision is required. What else? What else? Is that the manual level decision? Recently, one of the profit-making project is going to be loss-making. What to do with that? So there could be discussion between management at board meeting. So review board minutes to verify how management considering the matter and accounting for it to see if reasonable. Is that? Now might be company have communicated with the customer, okay, we are unable to deliver on time because these are the extra cost we need to incur, though we are suffering the cost. So please don't impose any penalty and please accept our request for delivery 2 months later. So we need to review any correspondence with the customer. So review any correspondence with the customer to identify any chances of penalty imposed due to late delivery. So at least 5 procedures we should discuss. Shall we move forward? The second issue concern, before moving to our second issue, let's discuss one accounting standard. IFRS 5. Discontinued operations and asset held for sale. It's covering two issues: discontinued operation and asset held for sale. What is discontinued operation? If business is going to discontinue its significant operations. What operations? Significant operations. What is meant by significant in accounting term? If those operations contributing 10% or more of profit, 10% or more of revenue, 10% or more of total assets. It's not material. Materiality, 5% or more of profit, 1% or more of revenue, 1% or more of total asset. That is used in audit. We are discussing accounting. In accounting, there is no material word used. In accounting, the word significant is used. And significant means 10% or more of profit, 10% or more of revenue, 10% or more of total assets. So if business is going to discontinue any of its significant operation, there must be a disclosure in the financial statement. Only one account relating to discontinued operation, there must be a detailed disclosure in the financial statement. If business is going to discontinue their significant operation this year, disclosure must be provided in current financial statement. If you are going to discontinue in next year, but you have made decision in this year before issue of current financial statements, disclosure is applicable in current financial statement. Either you are discontinue in this year, disclosure should be in this financial year statement. If you are going to discontinue next year after the financial statement, and you have made decision in this year, the disclosure is required in this year financial statement. And if there is any staff you are going to redundant, for that redundancy provision is separate required for IAS 37. This is discontinued operation. Now let's discuss about asset held for sale. If business is going to dispose significant asset, again, significant asset means that asset is 10% or more of total asset. In that case, you need to provide a disclosure in the financial statement. Number one. Number two, you need to present it separately, separate classification under current asset as held for sale, because this asset you are not going to continue for more than 12 months. Because in non-current assets, only those assets we state that we gonna continue for more than 12 months. So these assets should be separately classified under current assets, and you need to cease depreciation on that asset. And for this year, depreciation should not be charged on this asset. 3 accounting: separate disclosure, separate classification, and ceasing depreciation. Either you are disposing that asset in current year, this treatment should be there. Either you are going to dispose after the year end, but you have made decision in this year before year end. This treatment should be there in current year financial statement. Are you with me? And if you are separately classifying the asset, you need to record asset value on fair value basis. Before its value was say 80,000. Now you need to classify asset value on fair value basis, mean market value basis, not 80,000. Standard finish IFRS. Okay, the second issue concerning one of Bill Company's specialist division, which trades under the name Tryard Homes, and which deals exclusively in the redevelopment of non-industrial historic buildings such as castle and forts. These buildings are usually acquired as uninhabitable ruins and are then developed into luxury residence for wealthy individuals in these kind of special type of buildings. The management of Bill Company decided last week to sell this division, as although it is profitable, it generates a lower margin than other business division. They are going to discontinue one of the division. Tryard Home operates separately from the rest of the business and generate approximately 15% of total revenue of the company, and it is significant, contributing 10% or more of revenue. In the board minutes dated 1st June 20x1, what was the year end? 30th June 20x1, before year end. It was noted that interest has already been expressed in this division from a potential buyer, and it is hoped that sale negotiation will soon commence, leading to sale in August 20x1. It is going to be discontinued after year end. But as company have made decision before year end, so standard is applicable in current year financial statement. Being a significant, you need to provide a disclosure of discontinued operation. Is that? There is a specific office building and some other tangible assets that will be sold as part of the deal. Asset held for sale as well. The assets are recorded as $7.6 million in the financial statements. We need to compare with total assets and hence material. No redundancy will be necessary as employee contract will transfer to the new owner. Mean there is no issue of staff redundancy. So we will discuss first relating to discontinued operation. As per IFRS 5, if company is going to discontinue operation, company is going to discontinue significant operations, there must be disclosure in the financial statement. As company is going to discontinue after year end, but public announcement has been made before year end. So disclosure is required in current year financial statement. Then we'll put a heading what? Held for sale asset. Materiality 7.6 million is -% of total asset and hence material. For IFRS 5, if company is going to dispose of significant asset, separate disclosure is required in current year financial statement. Separate classification should be there. Should be moved from non-current assets to current assets, and the value should be based on fair value. And company need to cease depreciating this asset in the current year. Discontinued misstatement. If there is no detailed disclosure about discontinued operation in the current year financial statements could be misstated. If the held for sale asset is not measured on fair value basis, is not separately classified, or company is still charging depreciation, chances of manipulation in the financial statement. Easy. Audit procedures. What could be the audit procedures? There was some information about in a board minutes of 1st June, it was stated that there is interest from the customer buyer. So first we should review these board minutes. Review board minutes to verify how management considering the what disposal of division and accounting for it to see its if reasonable. Always review board minutes to verify how management considering the account balance and accounting for it to see if reasonable. What else? If there was any interest from the buyer, there could be any customer contract or any correspondence with the customer to ensure there is interest taken from the customer, means sale is going to be probable. Is that? Because the sale must be within 12 months. So review any correspondence with the customer or any customer contract to ensure sale is probable. Mean there are more chances for sale. What else? Whether there is disclosure in financial statements or not, how we can verify? Review notes to the accounts or notes to the financial statement. Review notes to the financial statements to ensure completeness of disclosures relating to discontinued operation and held for sale asset. We can review financial statement. Which financial statement component? Notes to the financial statements where there must be disclosure. Is that? What else? Can we discuss with the management as well? Can we discuss with management regarding the probability of sale? If there is no any customer correspondence or communication, then how we can confirm the sale is going to be happen within 12 months? Because it's not in current year, ultimately after year end. So after year end, it must be within 12 months. So discuss with management. regarding the probability of, say, after year end to see if reasonable, mean whether their discussion, their intention is reasonable or not. What else? What else? Any other procedure? When we normally sign audit report after 3 months of year end. What's the year end? 30th June. Sale is going to happen when? In post year end period. In final audit period. Is that? So review subsequent event. To verify the disposal of asset happen during August as per the plan. If it's not happened in August, chances that it will not happen within 12 months then. So we can write down 4 or 5 procedures. This will decide your pass or failure. Please be careful. Procedure evidence. So part A of the question for 16 good marks we have covered. Moving towards part B for 11 good marks. In addition, please critically evaluate the planning that has been completed by previously assigned audit manager. You need to evaluate the planning she has performed. From where? Planning memorandum working papers. Relevant details are provided in attachment 2, which contains notes made by her and placed on the current year audit file. Mean working paper. Make sure you include discussion of any ethical matters arising from the notes and recommend any action you think necessary. If there is any ethical issue, you need to discuss as well. Threats. 11 marks. In very first paragraph, there was one ethical issue. It is a long-standing audit client of your firm. Due to long-standing association with one client, familiarity threat arises that could affect auditor independence, objectivity. As per ACCA codes of ethics, key audit personnel must be rotated of the audit every 5 years. So we can discuss this long-standing relationship. Is there? So part B, what we are going to do, we are evaluating the planning as well as we are going to discuss ethical issues. So first heading we can put long-standing relationship. Familiarity threat we will discuss. Let's move towards attachment 2. Attachment 2 planning summary bill company's year ending 30th June 2021 prepared by Tara Lafayette, manager previously assigned to the audit. The planning for the forthcoming audit is almost complete. Time has been saved by not carrying out procedures considered unnecessary for this long-standing audit client. They have repeated again. Forecast accounts have been obtained and placed on file, and discussion held with management concerning business development during the year. She's saying forecast account have been obtained and placed on the file. But why these forecast accounts have been obtained? When we obtain forecast, when we see a forecast, when there is any going concern issue. So whether they were required for any cash flow going concern issue. If there was any issue, what you concluded, whether there is issue or not, is there any information? No, next analytical procedure detail is given. This is what? Poor documentation of the audit work, quality control issue. Is that? So we'll put a heading what? Forecast. So forecast has been obtained and placed in audit file. But what was the purpose behind obtaining this forecast? If it was for cash flow going concern issue that the normally auditor require, so whether that issue still there, whether that issue is resolved, whether you are satisfied with the management treatment, there is no other information given. So this indicates poor documentation of the audit work. You can explain? Okay. Analytical procedures have been performed on the statement of profit and loss and other comprehensive income, but not on the statement of financial position. My God. On balance sheet, analytical procedures were not performed. And this company is doing what? Construction business. They are having some contract with customers. There could be huge account balances recorded as inventory. If they are performing construction business, there could be some machinery assets available. Company have discontinued operations. They are going to dispose of some assets. There will be change in the assets as well, but analytical procedure not performed on balance sheet. As there didn't appear to be any significant movement in asset and liabilities since last year. No, there are chances of significant movement because business is going for discontinued operation and has for sale asset. So that is significant movement. Management confirmed there have been no changes to accounting system and control in the financial year. For this reason, we don't need to carry out walkthrough test. So there is no other information about analytical procedure. We'll put a heading analytical procedure. First, we will say at planning stage, we need to perform analytical procedure to highlight risky areas per ISA 300 audit planning, and must be performed on the whole financial statements rather than particular element of financial statement. And analytical procedures were not performed on a statement of financial position on the assumption there is no significant change in a statement of financial position, but company have disposed of significant assets, company have discontinued significant operations, so there is a significant movement. And not performing analytical procedure on balance sheet item, this is poor direction of the audit, quality control issue, poor direction of the audit. So 3 issues we have discussed. Management confirmed that there have been no changes to accounting system and controls in the financial year. No, there is change because company have discontinued significant operation. So there is change in the system. For this reason, we do not need to carry out a walkthrough test or review or documentation of the system and control. Walkthrough test is compulsory procedure that we need to perform before starting the work of every year audit, just to see whether controls are working as per recorded or not. Based on walkthrough test results, we'll be able to define our audit approach, whether we should retain system-based approach or we should move towards substantive approach. and not performing walkthrough test based on company management explanation, there is no change in internal control system. This is again poor direction of the audit work. Quality control issue. Management has also confirmed that there has been no changes to business operations other than the potential sale of triggered homes. All divisions are operating normally, generating sufficient profit and cash. For this reason, the business risk of bill company is assessed as low, and no further comments or discussion about business operations have been placed on file. We'll put a heading business risk. At planning stage, we need to assess business risk, and based on the assessment of business risk, we'll be able to assess risk of material misstatement. If there is a high business risk, high risk of material misstatement, low business risk, low risk of material misstatement. As company have discontinued their significant operations, there is a high risk, because now business need to be on survive for remaining operations. The revenue, the profit that you are contributing from that operation, that will not incur now. 15% of revenue they were contributing. So that 15% revenue business has lost. Now might be business will not be able to survive with the rest of the operations. So that's why business risk is high now. And per ISA 315, identifying and assessing risk of material misstatement through understanding the entity and its environment mean business risk. So risk of material misstatement is also high. So this is again what poor direction of the audit. Instead of assessing risk of material misstatement high based on business risk, they have assessed low due to wrong approach that business risk is low. Company auditor will not be able to assess the risk properly. The matter that will demand the most audit work is the valuation of property currently under development, especially the determination of the percentage completion of each development at the reporting date. Because based on percentage, company need to record the revenue. Historically, we have engaged a property valuation expert. We were using auditor's expert to provide a report on this area. Because how much work is completed, being auditor, we cannot determine while looking at the property. And if the engineer and if the expert will give a proper percentage, how much work has been completed. Based on that, we can verify, okay, how much percentage of revenue has been recorded in current year. So historically, previously we were using an expert for checking the percentage completion of work. However, bill company has recently employed a newly qualified architect who will be happy to provide us with evidence concerning the stage of completion of each property development contract at the year end. And he will provide that percentage that company management wish. Is that he is not independent because he is employee of client company. He might not be having experience of performing this kind of work. Using this person to produce a report on all properties being developed will save time and cost. Will save time and cost, but could affect audit quality. You will not be able to verify the account balance, especially revenue, properly if his percentage or his report is not based on accuracy. So we'll put a heading what? Property valuation. Our expert. So Till now, we were using auditor expert. And based on expert report, we were able to identify the property valuation, percentage completion of work, and the revenue recognition. Because revenue recognition should be based on percentage completion of work. But now auditor is going to rely on the work of the company employee. He could be expert, but he is not independent. So relying on a person that is working under company management will not provide proper evidence relating to the percentage completion of work and evidence. As per previous practice, we should use auditor expert. So relying on the work of company employee is again poor direction of the audit work. Is that? There is a auditing standard on expert as well. We're going to discuss later on, that is ISA 620. Before relying the work of expert, we should check his independence as well. If he's not independent, we should not rely on his work. And here there is an issue of independence. If we put the reference of this standard, examiner will be more happy. Bill Company has recently completed the development of luxury new office building in New Town. Several of the office units are empty. And the management of Bill Company has offered the office space to our firm for a nominal rent of $100 per year. If they have provided this office space below market rate, this is what significant hospitality, undue hospitality. And undue hospitality create what? Self-interest threat as well as familiarity threat. And significant hospitality should be avoided. If the $100 is below that market rate, we should not accept this, as it could influence independence of the auditor. Is that? For 11 marks, we have discussed 2 ethical issues, 4 marks, and we have discussed about forecast, analytical procedure, walkthrough test, business risk, and expert. I think we can achieve 11 marks. There is part B of the question as well. 4 plus 4, 8 good marks. Ben and Alex Bradley, the owner of the company, have a sister Jo, who runs an interior design company, Lantern Company. During a review of board minutes performed as part of the planning of Bill Company's audit, it was discovered that Bill Company has paid $225,000 to Lantern Company during the year. Who is running that Lantern Company? Their sister. In respect of refurbishment of development properties. On further inquiry, it was also found that Lantern Company leases an office space from Bill Company under an informal arrangement between the 2 companies. And they are also using office space from Bill Company as well. So this is what? Related party transaction. There is accounting standard IAS 24. Related party transactions. As per IAS 24, related party transaction must be disclosed in the financial statements regardless of the amount. Is that? If there is no disclosure, financial statement could be misstated. Who are related parties? Holding subsidiary. They are related party. Who else? Directors, their spouses, they are related party. Who else? Shareholder are related party or not? Not all. Having greater than 20% voting rights, they are related party. Those who are having less than 20% voting rights, they are not related. And if company have performed transaction with a related party, there must be a disclosure. Is that? Being auditor, we need to express opinion on the financial statement. If there are related party transaction and they have been disclosed properly, financial statements give 20 fair view. But if related party transaction have not been disclosed properly, financial statements are materially mistreated. Is that? This means regarding related parties, we should perform some procedures. There are some inherent limitations to verify related party transactions. Interface some inherent limitations relating to related party transactions. What are the inherent limitations? Sometimes it is difficult for company management to identify whether this transaction is an arm's length transaction or with a related party. They sometimes cannot identify. If it is difficult for management, it is difficult for the auditor as well. So sometimes it is difficult for management to identify separately. So it is difficult for the auditor as well. There is some limitation, like company system is not designed in a way that system can highlight related party transactions separate and routine arms and transactions separate. No company in a world having a system to identify related party transactions separate through the system. It's on company management. If they want to highlight, they can. If they don't want to, nobody can trace. So as a system is not designed, in a way to identify related party arms length transactions separately, so it is difficult for the auditor as well. Is that? Related party transaction management performed deliberately for any fraudulent financial reporting. And if they are performing deliberately, there could be chances to hide it. There could be attempt to hide. And if there is attempt to hide, it will be very difficult for auditor to identify, because auditor work is based on sample rather than 100% estimate. Is that? So if there is any deliberate attempt to hide by management, so it is difficult for auditor to identify. Is that? What else could be inherent limitation? So difficult for management to identify separate. So for auditor also difficult. System is not designed in a way to identify separately. So we cannot identify if there is a deliberate attempt to hide by management. So it is difficult for management. Sometimes these related party transactions are performed without any consideration. And if there is no consideration, means something going from the company, but nothing coming inside the company. And due to lack of consideration, there could be lack of recording of the accounting entry. So for accounting entry, you need to show the dual effect. With a single effect, you cannot record accounting entry. And if accounting entry is missing due to lack of consideration, lack of dual effect, so it will be difficult for auditor to identify. Because if the thing is not recorded in the accounting records, So ultimately, we cannot identify, we can identify through records. So these are four inherent limitations that auditor face relating to related party transactions. We need to remember these 4 points. Though there are limitations, we are the auditor. Relating to related party, if there is any chances of related party, if there is any indication of related party transaction, we should perform some procedures to verify related party transactions. What are the audit procedures that we need to perform per ISA 550, auditing related party transactions? We are going to discuss one more auditing standard, ISA 550. 560 we have covered subsequent event. 570 we have covered going concern. 580 we have covered written representation. We are going to cover 550, auditing related party transactions. If there are chances of related party transaction, being auditor, we need to inspect of certain transactions that are performed with unusual term of trade. The normal term of trades were not followed in those transactions, so we need to inspect them in detail. There could be chances of related party. The transactions that are performed with unusual discount rate. The normal company provide up to 10% discount. If there are any transaction where 50%, 40% discount has been provided, so we need to check that non-routine discount rate. Because there could be involvement of related parties. The transaction we need to verify that are offshore transaction. Offshore mean out of sea, foreign. Normally, if company subsidiary is based in foreign country, so to manipulate results, company perform transaction with subsidiary. So offshore transaction we need to check in more detail. And we need to check the transaction where management interests are involved. If companies dispose of any of the asset and that asset is bought by any of the director or their spouses. So there could be chances of fraudulent transaction. Obviously, these are related party transactions. So we need to see whether those transactions have been performed on arm's length, on any special amount, so that we can see that disclosure is provided in the financial statements appropriately or not. So these are the transactions, some we need to inspect in detail. We need to inspect some account balances in more detail. Receivable account balance we need to check in more detail because the receivable could include any related party. With the name of the ledger person, we can identify related party. Payable accounts, numbered bank accounts, mean those transactions where only the account bank account number is mentioned rather than name of the property, a party. That could be deliberate to hide the name because it could be a related party transaction. So we need to inspect the detail of certain accounts as well as member register. What is meant by member register? Shareholder register, through which we can identify who is the shareholder having more than 20% voting right. This means he is a related party and we need to remember his name. And while auditing, if there is any transaction with that name, this means this could be related party transaction. We need to discuss with the management regarding knowledge of related parties and transaction with them. Sir, have you identified any related party during the year? And if you have identified, have you performed any transaction with them? Please inform us. We'll discuss with them and we'll look at their face, how they are behaving. Either they are becoming confused or they are behaving normally. If they are becoming confused, this means they are hiding something. There could be chances. And based on that discussion, if they have explained, yes, these transactions we performed with related parties. So what do you need to do? We'll review the financial statements, whether those transactions they have informed us, whether they have been disclosed completely in financial statements or not. So review financial statement to verify completeness of related party transactions, completeness of related party transaction disclosure as per management discussion. In whatever they have informed us, we need to see whether those have been disclosed completely or not. And this is the area known only to management. So at the end of every year audit, we should obtain what? Written representation from regarding disclosure of related party transactions to the auditor and in financial statements. Please sign this page. Our related party relationship and transaction have been disclosed to the auditor and in the financial statements. Please sign this. So these 5 procedures we need to learn. These 4 inherent limitations we need to learn. Now moving towards part B of the question. Ben and Alex Bradley have a sister Jo, who is running an interior design company, Lantern Company. And during audit, we identified company have paid to 25,000 to Lantern Company for any refurbishment work. And that Lantern Company is using any of the office space from Bill Company on an informal arrangement. Required explain the inherent limitations, which mean that auditor may not identify related party and related party transactions. So those 4 points, Walmart straightforward. And part 2, recommend the audit procedures to be performed in relation to Bill Company transaction with the Lantern Company. So these procedures we can write down, as well as some procedure we can link with the scenario like this 225,000 payments. We need to verify through the vouchers, through the cash book bank statement. We can discuss with management the reason for these 225,000 payments to see whether relating to any work performed by the Lantern Company. We need to discuss with management regarding the office space arrangement, whether it is on arm's length basis, whether it is on a special term basis, or the rent is charged as per market rate. So 2-3 procedure we can relate with this issue as well. Otherwise, if we discuss these straightforward without linking with the scenario, even then we'll be able to get passing marks. So let's take a break. Let's take a break. After break, we'll discuss something.
Ja, je nog niet mee. Okay, that is a problem. Hmm.
Very classic.
Atomic class.
Yeah. Okay. For an individual company, we have practiced 4 good questions based on audit risk. Let's move towards group audit. We are going to discuss risk relating to group audit. Group audit means where a company is a parent company having different subsidiaries. In group audit, there are 2 auditors involved. One is called principal auditor. Other is called component auditor. Principal auditor, auditor of parent company. And component auditor, auditor of subsidiary. Component auditor have to express opinion, have to sign audit report of subsidiary financial statement. While principal auditor have to sign 2 audit reports, one on the consolidated statement of financial position and one on individual results of the parent company. Principal auditor signed 2 audit reports, one on consolidated financial statements, combined results of parent and subsidiary, and one individual of parent company, while component auditor is responsible for the audit of subsidiary company only. He need to sign audit report on subsidiary financial statements. This component auditor could be our firm, could be different firm as well. But whether component auditor is our firm, whether it is different firm, ultimately in consolidated financial statements, subsidiary results are going to be incorporated. So whether component auditor have performed his work properly or not, because if you haven't performed his work properly, this means subsidiary results were inaccurate. If subsidiary results are inaccurate, then consolidated financial statements are inaccurate. And if we are going to express opinion on consolidated financial statements being a principal auditor, and there were some misstatement due to subsidiary wrong results, who will be responsible for that? Principal auditor. That's why we need to make sure component auditor has performed his work properly. He has verified subsidiary financial statements properly, and for subsidiary results that are going to be consolidated, they are accurate. So that's why we need to perform some procedure for component auditor as well. What procedure we need to perform for component auditor, that we will discuss later on. So let's discuss about what could be the risk in case of group audit, in case of consolidated financial statements specifically. Suppose we were conducting audit of a company. Now that company is becoming a group. That company have acquired any other subsidiary. Mean before that company was preparing individual results, now they are going to prepare consolidated financial statements. Or we were conducting audit of a group. Now there is a change in group structure, new subsidiary has been added, our group have disposed of one of the subsidiary. Mean in case we are moving from single company to group audit, in case there is a change in group structure, there are some planning consideration that being a principal auditor we need to consider. Planning consideration relating to group audit. If we are moving from single company audit to group company audit, first we should make sure adequacy of resources, whether our firm is having appropriate resources to conduct audit of the group company or not. Obviously, if we need to conduct audit of consolidated financial statements as well as individual or parent company, so we need more time, we need more resources, we must be having skills of auditing a consolidated financial statements. So we need to make sure whether we are having adequate resources or not. We need to revise materiality levels. Because if a subsidiary is going to be added, ultimately total assets figure is going to be changed, profit figure is going to be changed because subsidiary results are going to be consolidated in consolidated financial statements. So we need to revise the materiality levels. As our work is going to increase, company management work is also going to be effective because now they need to comply with IFRS 10 consolidation. So we need to revise engagement letter as well. Because not only our work is going to change, our scope of audit is going to change, management responsibility going to change, auditor responsibility going to change. Ultimately, based on more work, we need to charge more fee. So we need to revise the engagement letter with the client. So that based on new terms of audit engagement, we should continue. So these are the three planning considerations that we need to consider if there is a change in group structure. Now let's discuss what could be the audit risk specifically to the group audit. Audit risk. In consolidation mean group audit, there could be chances of intergroup transactions. Parent subsidiary sometimes sell goods to each other. And normally they sell based on the markup margin. So what's the issue? There could be issue of unrealized profit. Unrealized profit that must be eliminated at consolidation per IFRS 10. So as per IFRS 10, unrealized profit relating to unsold inventory at the year end involving intergroup transaction must be eliminated. I mean, if they perform transaction with each other, if any of the inventory has been sold outside the group, so that profit has been realized. Suppose the inventory was 1,000 units, 8,000 units subsidiary sold to outside the group. So remaining 200 is still there that they bought from parent company. So relating to that 200 units, we need to eliminate unrealized profit part. If that unrealized profit is not eliminated at consolidation per IFRS 10, inventory profit could be overstated. These intergroup transactions are also related party transactions. So per IAS 24, there must be a disclosure about related party transaction. If there is no disclosure, financial statement could be misstated. Meaning if there is information about intergroup transaction between the parent subsidiary, what risk we can discuss. So unrealized profit part relating to unsold inventory at the year end must be eliminated at consolidation per IFRS 10. If unrealized profit is not eliminated, chances that inventory profit could be overstated. And our intergroup transactions are also related party transactions. So there must be a disclosure in consolidated financial statements per IAS 24. If there is no disclosure, financial statement could be misstated. So this could be the issue in audit, group audit. So what risk we can discuss relating to these intergroup transactions? There could be issue in a group audit of different accounting policies. Parent subsidiaries are having different accounting standards, different accounting policies. As per IFRS 10, parent and subsidiary must be having the same accounting standard, same accounting policies. But sometime, if a subsidiary is operating in a different country where there is a legal restriction, they need to comply with the local standards. like subsidiary need to prepare financial statements as per UK GAAP, not as per IAS, IFRS. So in that case, due to that genuine legal restriction, parent subsidiary accounting standard accounting policies could be different. If there are different accounting standard accounting policies, per IFRS 10, there must be a detailed disclosure in the financial statement, where in consolidated financial statements, regarding the detail of different policy standard, reason why they are different, and what is the effect on account balances due to these different policies. If the policies could be same, what could be the total assets, revenue, and total profit? And due to this difference, what is the change in profit, asset, and revenue that we need to disclose in consolidated financial statements? And if parent subsidiaries are having different accounting policies, and there is a lack of detailed disclosure as per IFRS 10 in consolidated financial statements, so financial statements could be misstated. There could be issue in group audit of different year end of parent and subsidiary. As per IFRS 10, parent and subsidiary company must be having the same year end. If they are different, you need to change either parent, either subsidiary, so that their year end must be aligned with each other. But there could be some legal restrictions, like subsidiaries operating in a country with government defining the year end. Like every company in the country have to prepare financial statements on 30th June only. They cannot prepare financial statements on any other year end. In that case, parent company, subsidiary company year end could be different. Then how the consolidation will be performed? There are two options. Either you need to consolidate at subsidiary year end, because for subsidiary there is a legal restriction, there is no legal restriction for parent, so you need to change parent year end. For this year, either you need to prepare extended financial statements or short financial statements, so that after that the issue will be resolved, both will be having same year end. But if suppose you don't want to change the income year end, and subsidiary year end is also different due to legal restriction, you cannot change. In that case, we can prepare consolidation at parent company year end by meeting a condition. What should be the condition? Parent company and subsidiary company could be different by meeting a condition. Parent company year end must finish before subsidiary year end, and the gap period between these two year end must be less than or equal to 3 months. In that case, we can prepare consolidated financial statements at parent company year end. If the gap period is greater than 3 months, you cannot prepare at parent company year end. You need to change the year end towards subsidiary. So if parent company, subsidiary companies are having a different year end. Why? Because there is legal restriction, we cannot change year end of subsidiary. So there are two options, either prepare consolidation on subsidiary year end, or prepare consolidation on parent company year end by meeting a condition, like a parent account must finish before subsidiary year end, and the gap period between these two year end must be less than or equal to 3 months. If this condition is fulfilled, yes, we can prepare consolidation on parent company year end. How? These are the subsidiary 12 months accounts. What we will do, the common period, say 9 months, 10 months, we will apportion and consolidate, and these are what? Audited accounts. The common period, we will apportion and consolidate, and these will be what? Audited accounts. And for the remaining gap period, What we need to do, we need to prepare what? Interim accounts. And those interim accounts will be unaudited. So what we need to do, we need to audit them, review them, and then we will consolidate. I think there is something wrong. We can prepare consolidation at subsidiary year end, parent company year end. If subsidiary year end finish before parent company year end, and the gap period between these two must be equal to or less than 3 months. Means subsidiary year end must finish before parent company year end. So in that case, these are the subsidiary 12 months accounts audited. So these 12 months, 9 months are common period that we will apportion and consolidate. And for remaining 3 months, we need to prepare what? Interim accounts. So interim accounts we need to prepare for remaining 3 months of the subsidiary rather than the parent company. Because subsidiary accounts we need to consolidate. And subsidiary year end finish before parent company year end. Suppose subsidiary year end is 30th September and parent company year end is 31st December. So subsidiary accounts we are having for the complete year, this 12 months. After these 12 months, 9 months are aligned with the parent company. So we'll apportion subsidiary 9-month accounts that are audited and we'll consolidate the parent company. And for remaining 3 months gap period, we need to prepare interim accounts of the subsidiary. We need to verify them, and then those accounts will be consolidated. Now we'll be able to perform consolidation for 12 months. And every year, we will be involved in this problem. That's why it's better for this year either to prepare extended accounts of parent company or short accounts of parent company and consolidate at subsidiary year end and define that year end for the parent company as well. So that in future period, this issue will be resolved automatically. So what could be the issue in group audit? If parent company and subsidiary companies are having a different year end. So if the consolidation is not done with the proper apportionment of subsidiary result per IFRS 10 by meeting the condition, financial statement could be manipulated. Because these 9 months we need to apportion. The first 3 months results we do not consolidate. We need to consolidate only the common period results. Common period means those 9-10 months results we need to apportion, and this apportionment is a difficult task. And these gap period accounts are not available. So we need to ask the subsidiary management to prepare these gap period interim accounts. We need to verify ourselves, or we need to request the subsidiary component auditor to verify these accounts, and then that will be consolidated. So this will be the issue for whole life. So if there is inappropriate apportionment of subsidiary accounts, our subsidiary accounts are consolidated without meeting a condition of a gap period of less than or equal to 3 months. So financial statements could be manipulated. In group audit, what could be the issues? In group audit, the issue could be acquisition during the year. If during the year any of the subsidiary is acquired, what could be the problem? Only post-acquisition results of subsidiary must be consolidated rather than pre-acquisition results. And if due to inappropriate apportionment, pre-acquisition results have also been consolidated, financial statements could be manipulated. So only post-acquisition results should be consolidated as per IFRS 10. As well as there could be issue of contingent consideration. To acquire subsidiary, ultimately we are paying consideration. So that consideration, including contingent consideration, must be incorporated in calculation of goodwill. But that contingent consideration must be incorporated in calculation of goodwill, but using discounted at present value method, not the complete amount. Should be incorporated into goodwill calculation using discounted at present value method. If it is not discounted at present value method, then goodwill could be manipulated. You are paying, say, 80 million now, remaining 20 million you will pay after 3 years. So consideration paid is not 100 million. This 80 we can come charge full, but this 20 million we need to discount at present value method of our 3 years, and that amount we should incorporate in calculation of goodwill rather than complete 20 million. If it is not discounted at present value method, goodwill could be manipulated. In case of acquisition during the year, fair value of net assets acquired should be measured properly per IFRS 3. IFRS 3, business combination. If the fair value of net assets acquired is not measured properly, goodwill could be manipulated. And if you are recording the goodwill in case of acquisition during the year, there must be impairment of goodwill as per IAS 36. And if goodwill is not impaired as per IAS 36, chances that asset profit could be overstated and expenses understated. Impairment expense debit, goodwill asset credit. So if there is information acquisition during the year, what point we can discuss? If there is acquisition during the year, only post-acquisition results of the subsidiary should be consolidated rather than pre-acquisition. And due to inappropriate apportionment of pre-post-acquisition results, chances that financial statements could be manipulated. Goodwill relating to newly acquired subsidiary could be manipulated if the contingent consideration is not accounted for using discounted at present value method. Fair value of net assets acquired relating to acquired subsidiary must be measured properly as per IFRS 3. If fair value of net assets acquired is not measured appropriately, goodwill could be manipulated. As per IAS 36, there must be an impairment review on the goodwill. If goodwill is not impaired, chances that asset profit could be overstated and expenses understated. These 3-4 risks we can discuss in case of acquisition during the year. In group audit, there could be issue of disposal during the year. If there is a disposal during the year per IFRS 10, only pre-acquisition results must be consolidated, not pre-disposal result must be consolidated rather than post-disposal. So only pre-disposal results should be consolidated per IFRS 10. And if due to inappropriate apportionment of pre-post disposal results, chances that financial statement could be manipulated. If there is disposal during the year, asset relating to disposal group must be eliminated from asset register. Elimination of asset relating to disposal group must be eliminated from asset registered as per IFRS 10. And if assets have not been eliminated properly, chances that asset could be overstated. If any of the subsidiary disposed during the year, there must be elimination of goodwill relating to disposal group from goodwill account as per IFRS 3 business combination. If goodwill relating to disposal group is not eliminated, chances that goodwill asset could also be overstated. If business have disposed a subsidiary, is that significant discontinued operation? Yes. So per IFRS 5, there must be a disclosure about this discontinued operation. In case of no disclosure, financial statement could be misstated. In these points, we're gonna discuss if there is any disposal of subsidiary during the year. Only pre-disposal result must be consolidated per IFRS 10 rather than post-disposal. In case of inappropriate apportionment, financial statement could be manipulated. Per IFRS 10, asset relating to disposal group should be eliminated from asset register. If there is no elimination, chances that asset could be overstated. Per IFRS 3, goodwill relating to disposal group should be eliminated from goodwill account. If not eliminated properly, goodwill could be overstated. And per IFRS 5, significant discontinued operation must be disclosed in the financial statement. And if there is no disclosure, chances that financial statement could be misstated. In group audit, there could be chances of a foreign subsidiary. Subsidiaries operating in other country, and that country currency is different than parent company currency. This means we need to translate subsidiary results so that we can consolidate with the parent company currency, preparing financial statements. So what's the accounting standard on foreign subsidiary? IAS 21. As per IAS 21, income statement items should be translated using average rate. Balance sheet items should be translated using closing rate or current rate. Foreign exchange gain or loss. Foreign exchange gain or loss should be charged to profit and loss account. Foreign exchange gain or loss relating to retranslation of subsidiary assets. Gain loss relating to retranslation of subsidiary assets must be charged to OCI. And if company is not accounting as per above criteria, financial statement could be manipulated. So what are the risks specific relating to group audit? In case of intergroup transactions, unrealized profit part relating to unsold inventory at year end must be eliminated at consolidation per IFRS 10. If it is not done properly, chances that inventory profit could be overstated. And due to intergroup transaction, there must be a related party transaction disclosure in the consolidated financial statement. In case of no disclosure, financial statement could be misstated. What could be the issue in group audit? Subsidiary and parent companies are having different accounting policy, different accounting standard. So per IFRS 10, there must be a detailed disclosure in the consolidated financial statement regarding the different policies, reason for the difference, and effect on the account balances. If there is no detailed disclosure provided, financial statement could be misstated. What could be the issue? Parent subsidiaries having different year end. If due to different year end, consolidation is not done at a subsidiary year end, are not done at parent company year end by meeting condition with proper apportionment, chances that financial statement could be manipulated. What could be the issue? Acquisition during the year. So Only post-acquisition results of subsidiary must be consolidated rather than pre-acquisition. Due to inappropriate apportionment of results, financial statement could be manipulated. If there is any contingent consideration involved, that must be incorporated into goodwill calculation, but based on discounted at present value method per IFRS 3. If contingent consideration is not discounted at present value, goodwill could be manipulated. Fair value of financial assets required relating to a subsidiary must be measured appropriately as per IFRS 3. If fair value of financial assets required is not properly measured, goodwill could be manipulated. For IAS 36, there must be an impairment review of goodwill. In case of no impairment, chances that asset profit would be overstated, expenses understated. There could be issue of disposal of subsidiary during the year. For IFRS 10, only pre-disposal result must be consolidated. And due to inappropriate apportionment of the disposal group results, chances that financial statement could be manipulated. Asset relating to disposal group must be eliminated from asset register. If they are not eliminated, chances that asset could be overstated. Goodwill relating to disposal group must be eliminated from goodwill account per IFRS 3. If there is no elimination of goodwill, chances that asset could be overstated. For IFRS 3, there must be a disclosure of significant discontinued operation. And if this subsidiary discontinued operation is not disclosed properly, chances that financial statement could be misstated. Issue could be foreign subsidiary. For IAS 21, income statement item should be translated using average rate. Balance sheet item should be translated using closing rate. Foreign exchange gain loss should be charged to P&L, and foreign exchange gain loss relating to retranslation of subsidiary assets must be charged to other comprehensive income. If foreign subsidiary results not accounted for above criteria, financial statement could be manipulated. Now we can tackle every group audit question. Let's move towards our question. Grissom. Where is Grissom? So requirement. Yes. Requirement A for 18 good marks. Having 4 professional marks as well. Respond to the email from engagement partner. What is email? To manager from Warwick Stoke, normally his partner, regarding Grissom Group audit planning. Hello, I need you to help me get started on planning for the audit of consolidated financial statements of the Grissom Group. And to this end, please prepare briefing notes for my attention in which you identify, explain, and evaluate principal audit risk. In previous question, there was a requirement either to identify, explain, evaluate audit risk or risk of material misstatement. Now the term is used what? Principal audit risk. Principal audit risk mean risk of material misstatement. How many marks? 18 mean risk where accounting standards are involved. We can discuss for at least 2 marks. And any risk where there is no accounting standard involved, that we can discuss for 1 mark. Ignore those risks that relate to reliance on another auditor, as they will be dealt with separately. Thanks for it. So let's move towards discussing principal audit risk. So part A, principal. So whatever the issue we will identify, we'll put the heading, discuss accounting standard, chance of misstatement, similar way. So you are senior audit manager in Vegas and company responsible for the audit of a Grissom Group, which has been an audit client for several years. The group companies all have a financial year ending 30th June 2020. So parent subsidiary all are having same year end. And you are currently planning the final audit of consolidated financial statement. The group's operations focus on manufacture and marketing of confectionery and savory snacks. Information about several matters relevant to the group audit is given below. These matters are all potentially material to the consolidated financial statement. None of the companies in the group are listed. And if we see, the companies are Grissom Company, Willow Company, Hodge Company, Brass Company. Might be these Willow, Hodge, Brass are their subsidiaries. Could be associate as well. So Grissom Company, this is a non-trading parent company, which wholly owns 3 subsidiaries, Willow, Hodge, and Brass, all of which are involved with the core manufacturing and marketing operations of the group. This year, the director decided to diversify the group's activities in order to reduce risk exposure. Non-controlling interest representing long-term investment have been made in 2 companies, an internet-based travel agent and a chain of pet shops. Other than these 3 subsidiaries, they have made investment in some internet-based travel agent and a chain of pet shops as well. In the consolidated statement of financial position, these investments are accounted for as associate, as Grissom Company is able to exert significant influence over the companies. If you are having control on any other company, when you are having control, when your investment is greater than 50%, then that will be called subsidiary. For subsidiary, we need to prepare line by line consolidation. All the income statement item, balance sheet item of subsidiary, we need to add with the parent. If you are having significant influence, not control, significant influence. Significant influence means your holding is between 20% to 50%, mean less than 50, above 20. As well as not only holding, involvement in decision making. Of investee company. Investee mean where you made the investment. In that case, we will call it associate. If there is only holding, but no involvement in decision making of that company, this will not be called as associate. Significant influence mean you are having holding as well as you are able to influence the decision making of that company. Ultimately, if you are having investment more than 50, then you are the boss. Then you can change everything. Ultimately, you are involved in decision making. Without you, they cannot approve their strategies. So in that case, that is subsidiary. For subsidiary, there must be line by line consolidation. All the results of subsidiary should be added with parent. For associate, there is only one consolidation. That is what? The profit from associate you need to record separate in profit and loss account and add in the investment in associate. You don't need to incorporate the results of associate with the parent company. My teacher who taught me consolidation, according to him, the subsidiary is what like your wife. Parent company is husband, subsidiary is wife. Darling, your asset, mine asset, your liabilities, mine liabilities. That's why you need to consolidate subsidiary results with parent company. Your everything is mine. This associate is what? Beautiful girlfriend. Darling, your asset, your asset. Your liabilities, only your beauty, profit is mine. So that you need to consolidate. Now, hope we can understand why associate results we don't need to consolidate. Only profit part we need to consolidate. So company have made investment into other companies and they have recorded it as associate. So we'll put a heading here, associate. Here is accounting standard on associate. IAS 28. As per IAS 28, if you have acquired more than 20% holding of other company but below 50, as well as there is involvement in decision making of the investing company, this should be recorded as associate in consolidated financial statement. And there are chances if Grissom Group is having only the holding but not the involvement in decision making, and they have recorded as associate, chances that financial statement could be manipulated. Is that? They are only helping a holding. Our holding is below 20. They are involved in decision making only. In that case, it's not associate. So two conditions must be fulfilled: holding above 20, below 50, as well as involvement in decision making of the invested company. So we can discuss one risk for 2 marks. As part of their remuneration, the directors of Grissom Company receive a bonus based on the profit before tax of the group. Directors' remuneration include bonus based on company profitability. And if the required target profit is not met, there are chances of manipulation of results. So we will put the heading bonus and we can discuss this for 1 mark because no accounting standard is involved. Chance of misstatement. In April 2010, the group finance director resigned from the office after a disagreement with the chief executive officer over changes to accounting estimate. A new group finance director is yet to be appointed. We'll put a heading, what finance director. In case of absence of a finance director, if controls are not monitored properly, chances of error in financial statement. This is control risk. But we are discussing at risk of committee statement, chance of error in financial statement. So we'll discuss for 1 mark. Because they haven't appointed new finance director. So in case of absence of finance director, if controls are not properly implemented or monitored, chances of error in financial statement. Why he resigned? Due to disagreement on changes to accounting estimate. Accounting estimate, is there any accounting standard on that? There is IAS 8. Change in accounting policy, estimate, and prior period errors. As per IAS 8, if company has changed accounting policy during the year, there must be a disclosure in the financial statement, as well as retrospective effect mean prior adjustment should be there. If company have changed accounting estimate, there must be a disclosure only, no prior adjustment is required. So as company have changed the accounting estimate, so para IAS 8, there must be a detailed disclosure in the financial statements. In case of no disclosure, financial statement could be misstated. For 2 marks, we can discuss this. So we have discussed 4 issues, 2, 3, 4, and 2. For 6 marks, we have discussed out of 18. Okay. Now we see there is information about the Velo company. So this means we are going to discuss issues relating to Velo company. So put a heading Velo company. Sometime in question, they provide some information, numeric information about each subsidiary. Then we can calculate the materiality of each subsidiary as well. Otherwise, now all the risk, all the issue relating to this Velo subsidiary we will discuss under its head. Then for Hodge company, we will discuss under Hodge company head. Velo company, this company manufactures and distributes chocolate bars and cakes. In July 2009, production was relocated to a new, very large factory. One of the conditions of the planning permission for the new factory is that Velo company must, at the end of the useful life of the factory, dismantle the premises and repair any environmental damage caused to the land on which it is situated. Dismantling cost. The issue is what? Dismantling cost. So we'll put a heading dismantling cost. For IAS 16, dismantling cost should be capitalized to the asset, as well as provision must be created against it. In asset debit, provision credit. And this provision should be recorded using unwounding of discount. We charge occasionally, we eliminate over the time period. If this dismantling cost have not been capitalized, or provision is not recorded, or provision is not unwoundedly discounted, chances that financial statement could be manipulated. So whenever we are facing any issue relating to dismantling cost, we'll say per IAS 16, dismantling cost should be capitalized to the asset cost and provision must be created against it. And that provision must be unwoundedly discounted over the time period. And if company is not accounting as per above criteria, financial statement could be manipulated. 2 marks. Okay. So now we are moving towards Hodge company. So put a heading Hodge company and discuss their risks separately. This company's operations involve the manufacture and distribution of packaged nuts and dried fruit. The government paid a grant in November 2009 to Hodge company to assist with the cost associated with installing a new environmental friendly packing line in its factory. To put a heading government grant. Here is accounting standard IAS 20. Government grants are of 2 types: revenue nature, capital nature. Revenue nature must be recorded as income. If relating to future, should be recorded as deferred income. Capital nature grant must be deducted from asset cost, and with the remaining amount, assets should have been accounted for. If these are not deducted from asset cost, or asset is not recorded with the remaining amount, financial statement could be manipulate it. One thing, capital nature grant must be deducted from asset cost, and the remaining amount asset should be accounted for. If there are any conditions attached to the grant and company is not meeting the condition, in that case, company need to record provision for the full amount of the grant, because if you are not meeting the condition, government can call back their grant. And if they are calling back, they will call back the full. Either you have spent some, no, they will call back full. So provision must be created for full amount of the grant for IAS 37. Okay, let's see what's happening here. So the government paid a grant in November 20X9 to Hodge Company to assist with cost associated with installing a new environmental friendly packing line in its factory. And they are providing to install environmental friendly packing line. The packing line must reduce energy use by 25% as part of the condition of the grant. If your energy usage is not reduced by 25%, government can call back. There is condition attached. And they began operating in February 2050. What was the year end? I think so, 31st December. I think so, all the companies having 30th June year end. So February 2050 mean during year. So revenue nature or capital nature? Installing new environmental friendly packing line, capital nature. So capital nature grant must be deducted from asset, and with the remaining amount asset should have been recorded. And there is condition attached, reduction of energy usage by 25%. If company not meeting the condition, company need to create provision for the full amount of the grant. In case the grant is not deducted from asset cost, chances that asset could be manipulated. And in case of non-compliance with the condition attached, provision is not created, expenses, liabilities could be understated and profit overstated. We can discuss for 2 marks. Now we are moving towards brass company. So we'll put a heading brass company. Is there any risk relating to group we have identified yet, except associate? No. This is a similar way we are practicing individual company. Already question. So brass company. This company is a new and significant acquisition purchased in January 2050. Acquisition during the year. Adding acquisition during year. There is no other information. So we'll say only post-acquisition result must be consolidated per IFRS. Then in case of inappropriate apportionment of reserves, financial statement could be manipulated. Fair value of net assets required must be properly measured as per IFRS 3. If it is not measured appropriately, goodwill could be manipulated. Is there any information about contingent consideration? No, we will not discuss. If there is any involved, we will discuss that point. Otherwise, do not discuss. Is there any goodwill information? No, we will not discuss about impairment even. These 2 points are enough. 2 marks. It is located overseas in Chocolate, a developing country. It is located overseas. What does that mean? Foreign subsidiary. For IAS 21. Income statement item should be translated using average rate. Balance sheet item should be translated using closing rate. Foreign exchange gain loss should be charged to P&L. Foreign exchange gain loss relating to retranslation of subsidiary assets should be charged to OCI. If companies are not accounting as per above criteria, financial statement could be manipulated. Always omit these points in case of foreign subsidiary. And has been purchased to supply cocoa bean, a major ingredients for the goods produced by Willow Company. She is brass buying, selling something to Willow Company. What is this intergroup transaction? Is that for IFRS 10? Unrealized profit part relating to unsold inventory at year end must be eliminated from consolidation. If unrealized profit is not eliminated per IFRS 10, financial statement of inventory profit could be overstated. And intergroup transactions are also related party transactions that must be disclosed per IAS 24. In case of no disclosure, financial statement could be misstated. 3. Risk relating to group we have identified finally. It is now supplying approximately half of the ingredients used in Willow Company manufacturing. Chocolate, where that subsidiary is based from, has not adopted IFRS, meaning that Brass Company financial statements are prepared using local accounting rules. What is this? Different accounting. If parent subsidiaries are having different accounting policies, there must be a disclosure in consolidated financial statements per IFRS 10 relating to different policies, reason, as well as effect on account balances. In case of no disclosure, financial statement could be misstated. The company uses local currency to measure and present its financial statements that we have discussed in foreign subsidiary. Is that further information? Your firm audit all components of the group with the exception of Brass Company, which is audited by a small local firm, Siddle and Company. Mean subsidiary auditor are different. What to do with that different auditor or component auditor, we will discuss in next lecture. The part A of the question is completed yet. B, C still left. If we look at part A, for 18 good marks, have we justified 18 marks? 2, 3, 4, 6, 8, 10, 12, 14, 16, 18, 9. Now 10 issues we have discussed, 2 for 1 mark and remaining 8 for 2 marks. Is that? This part C we can cover now. Audit procedures for 4 marks. To verify classification of non-controlling investment made by some company, mean to verify associate. This is associate rather than only investment. How we can verify holding? Inspection of a purchase contract to verify amount of investment, and inspection of share capital of investing in a company to calculate percentage of holding as per the amount of investment. Proper procedure. Or means verify through share certificate, but share certificate will show only the investment. Your investment is more than 20% is not, this we need to verify. Investment is there, but whether it is associate or not, this we need to verify. When this will be associated, when you are having investment more than 20%. So first you need to verify the amount from purchase contract. Then you need to inspect the share capital of investing company financial statements and calculate the percentage of holding as per the amount of investment. There is a holding. It is still not associate if you don't have involvement in decision making. Now we can verify involvement in decision making. Discuss with management regarding their involvement in the decision making of investee company to see if reasonable. I mean, they will say, oh, yes, we were involved there. These were the issue we approved. We were fully involved there. Okay, that's fine. Every company state the name of their directors in their annual reports. Is that what we can do? Review financial statement annual reports of investee company to identify name of directors included there. If in the director list there are no names relating to this, there is some company management. This means they are not involved. Is that? What else? What else? What else? If they are receiving any dividend, profit part, how they are receiving? Through dividend vouchers. Is that? We see they are recording as a profit, they are adding to an investment. So inspection of dividend vouchers and cash book bank statement to verify dividend received from investee company. Because if there is investment, ultimately they are receiving dividend, and dividend they are receiving against what? Dividend vouchers. Is that? 4 procedures you need to write down relating to condition. Mean companies and meeting condition or not. What was the condition relating to grant? 25% reduction in energy. First, we need to verify whether the condition is 25% reduction in energy. There is no other condition. From where we can identify the condition? Contract. So inspection of government grant contract to verify condition attached is a 25% reduction in energy only. There is no other condition. Now we need to verify whether company is meeting condition or not. Because if they're not meeting, there must be premium. So compare current energy bill with the previous to verify energy usage has been reduced by 25%. Is that how company can reduce energy? By installing some assets. If they have installed any assets, we should verify. How? Physical inspection of the area where assets has been installed to reduce the energy usage. Is that? What else? If company is not meeting condition, there must be some communication between company and government body. So review correspondence between company and government body to identify any chance of non-compliance with the condition. Because their discussion will show whether they are complying or not complying. 8 procedures. So part B of this question left that we will cover in next lecture. Till now, we have discussed some auditing standards. We have covered ISA 320 on materiality, ISA 700 standard audit unmodified report, 705 qualified report, 706 emphasis matter, other matter, 701 key audit matter, 710 comparatives, 720 other information, What else? 500. 500 audit evidence. 510 opening balance.
Balance 520.
520 analytical procedure.
560 subsequent event.
550 we covered today. Related party. 560 we have covered. Subsequent event. 570 we have covered. Going concern. 580 we have covered. Return representation.
Sure.
What else? 300 audit planning.
315.
315 audit risk. 330 response to risk. Only these standards we have discussed so far. 610 620 402. 610 620 402. These are small 3 standards. For these standards, I will share one video. 610 is relating to internal audit. 620 is relating to expert, and 402 is relating to service organization. Examiner never ever tested these standards separately. They could be referred while discussing certain issue, like in bill question there was issue of expert, so we can just provide a reference of expert standards ISA 620. We need to check the independence of expert. Like this reference we need to provide. So mainly these standards examiner test in detail in AA paper, not AAA. But we must be aware about their knowledge. So for these 3 standards, I will share a video, probably half an hour, so that we can spend time on practicing more questions. So for these 3 standards, I will share a video. So see you in next lecture. We'll continue with group audit. We'll practice 2-3 good question on group audit. So see you next Saturday.
Thank you, sir.